Hey everyone, and welcome to this explainer. I am absolutely thrilled you're here with us today because we are stepping right into a masterclass on one of the most fascinating and honestly most misunderstood corners of the financial world. We're talking about riskier mutual fund products. So grab your metaphorical notebooks because we're going to unpack the mechanics, the hazards, and of course the potential rewards of these incredibly complex investment vehicles. Think of this as your diploma-level guide where we take all that dense financial theory and transform it into clear, actionable knowledge. Let's get started. To really ground this academic theory in reality, let's look at a real-world dilemma. Meet Sarah. She owns a highly successful tech repair shop right here in Canada. After a few really great years, she's accumulated some healthy retained earnings. But now she's facing the classic investor's crossroads. Should I keep my company's surplus cash safe, or do I risk it for higher growth? Now, mutual funds might seem like a no-brainer because they pool money to offer diversification, which naturally reduces unsystematic risk. But as Sarah is quickly learning, not all mutual funds are created equal. Some are structured specifically to chase aggressive capital appreciation rather than just keeping our hard-earned cash safe and sound. Okay, let's dive into this. Here is our syllabus for today. We'll start with the risk-return trade-off, move into the anatomy of investment risks, explore high-risk equity funds, tackle complex alternative funds, weigh the pros and cons, and finally look at managing risk right here in Canada. Module 1, the risk-return trade-off, balancing growth and uncertainty. And this brilliantly illustrates the fundamental golden rule of investing. If you seek higher returns, you absolutely must accept a correspondingly higher level of uncertainty, variability, and potential for loss. It's just an unavoidable structural relationship in finance. Our chart here illustrates this spectrum perfectly. Over on the left, government bond funds offer low risk, but consequently very low returns. In the middle, your standard equity funds offer a medium balance. But look over at the far right. Leveraged funds sit at the absolute extreme edge. They offer the potential for massive returns, sure, but they carry an equally massive risk of severe loss. Sarah can't simply opt for that tall return bar without strapping herself in for the intense volatility that comes with it. Moving right along to Chapter 2, the anatomy of investment risks, going well beyond the basics. To actually help Sarah make an informed decision, we first need to categorize the specific hazards. Here we have our taxonomy of risk. As a well-informed investor, you've got to analyze how these different variables intersect. So, market risk is your broad, systematic risk. Think global recessions or pandemics dragging everything down at once. Volatility risk is the sheer whiplash of rapid price changes. If you're holding bonds, you face credit risk, which is just the chance the issuer defaults, and interest rate risk, where rising rates crush your bond prices. Finally, we have liquidity, currency, and sector risks. Let's break a couple of these down into practical terms. Let's make this tangible. Take liquidity risk. The textbook definition is the inability to quickly buy or sell an investment at a fair price. But let's apply this to Sarah's business. Imagine she customized a highly specialized delivery van for her tech repair shop. If she suddenly needs cash and tries to sell that weird, hyper-specialized van by tomorrow morning, she's going to have to drastically slash the asking price, right? The exact same thing happens in mutual funds that hold obscure small-cap stocks. If the fund manager needs to sell them quickly, there just might not be an active market, leading to severe price cuts. Then there is currency risk, which is absolutely crucial for us Canadian investors to understand. Our source text points out a really important scenario. If a Canadian investor invests in U.S. assets and the U.S. dollar weakens against the Canadian dollar, the investment value may decrease. This literally means Sarah could pick a brilliant U.S. mutual fund where all the underlying stocks go way up in value, but if the exchange rate moves against her, she still loses money. She's taking on a completely independent variable of risk. Chapter 3, High-Risk Equity Funds, where it's all about chasing capital appreciation. So, the crucial point is that high-risk equities essentially throw capital preservation right out the window to chase aggressive growth. Take small-cap funds, for example. These funds invest in tiny, emerging companies. And yes, they offer incredibly high growth potential, mostly because it's way easier for a $10 million company to double in size than a $100 billion giant. But because of that, they are subjected to very high volatility and serious liquidity issues. These are strictly for aggressive investors who are emotionally and financially prepared to watch their portfolio's values swing wildly from month to month. And, the risk spectrum of equities extends even further. Sector funds concentrate all their capital into just one industry, like tech or healthcare, completely sacrificing diversification. Emerging market funds introduce severe political and economic instability. Commodity funds rise and fall on global supply-demand shocks for things like oil or gold. And then there are thematic funds. These invest in highly speculative future trends like AI or blockchain. And let's be real, if the trend stalls out, the fund just plummets. Now for Chapter 4, Complex Alternative Funds and Advanced Strategies. Leaving traditional stocks and bonds completely in the dust, alternative funds use advanced mathematical strategies that go far beyond your standard buy and hold approach. The poster child for this category is the leveraged fund. These use borrowing and financial derivatives to actually multiply the exposure to a market, often aiming for 2 or 3 times the daily performance of an index. And I really want to stress the word daily here. Because they rebalance every single day, the compounding effects over weeks or months can lead to entirely unpredictable results. They are generally considered highly unsuitable for your average long-term investor. Let's move to the next slide and see how this danger builds when we introduce inverse funds. While leveraged funds amplify the market's direction, inverse funds are designed to generate a profit when the market actually declines. They use complex derivatives, like futures and swaps, to pull this off. They're essentially speculative tools or very short-term hedges. The massive glaring danger here is that over the long run, markets generally go up. So if an investor holds an inverse fund during a multi-year bull market, they can experience catastrophic compounded losses. Finally, in this highly complex tier, we have alternative hedge-like mutual funds. These aim to make money regardless of whether the market is rising or falling, using tactics like short selling, arbitrage, and aggressive derivatives trading. But here's the catch for everyday investors. These sophisticated models are notoriously difficult to monitor. They operate with far less transparency than traditional funds, and because they require highly specialized managers, they charge exorbitant management fees that eat directly into your returns. Chapter 5. Weighing the pros and cons. Is it actually worth the risk? Looking at this somewhat intimidating landscape, how does Sarah practically weigh these academic realities against her very real business goals? Well, this lays out the ultimate trade-off. On the pro side, you get access to high return potential. You gain entry into specialized emerging markets, and you have professional managers handling all those complex traits. But the cons are incredibly heavy. Extreme short-term volatility, the very real potential for massive capital loss, and the sky-high fees required to pay those professional managers. I mean, if a high-yield junk bond fund charges a massive fee, it needs to generate an even higher return just for you to break even. Ultimately, it all boils down to investor suitability. Who actually possesses the psychological patience and the financial runway to ride out a 40% market correction without totally panicking? These funds are typically ideal only for young investors who have decades to recover, or individuals with highly stable surplus income who are aggressively seeking growth. They are definitively not suitable for retirees who need capital preservation or risk-averse folks who are going to lose sleep over daily market drops. Our final chapter, Chapter 6, Managing Risk in Canada, Strategies and Protections. If Sarah determines she does have the appetite for some risk, she needs a game plan. Here are the 4 essential steps to prevent a catastrophic error. Step 1, diversification. Never, ever put all your surplus business cash into one volatile sector fund. Step 2, asset allocation. Balance out those high-risk mutual funds with incredibly safe, boring government bonds. Step 3, regular monitoring of macroeconomic indicators. And step 4, which is perhaps the absolute most important, maintain a long-term perspective to avoid the worst mistake any investor can make, panic selling at the bottom of a market downturn. Now, what's really interesting about this slide is how our specific environment actually protects us. In Canada, mutual funds are strictly governed by the Canadian Securities Administrators, or the CSA. They enforce mandatory disclosures, so before Sarah buys a single thing, she'll have access to standardized risk classification systems and a plain language fund facts document. This ensures that the transparency she needs to align an investment with her specific financial goals is right there in black and white, legally mandated. I want to leave you and Sarah with this provocative question to chew on. If your primary business faced a sudden, unexpected downturn tomorrow, could your investment portfolio psychologically and financially withstand a 30% drop today? If the answer is no, those riskier mutual funds might not belong in your portfolio just yet. Thank you all so much for joining me in this masterclass explainer. If you found this deep dive helpful, please hit that like button to let me know and subscribe to the channel so we can keep untangling these complex topics together. Catch you next time.